Building a solid financial life does not begin with selecting complex investments or seeking extraordinary opportunities. It starts with a foundation. Financial independence is the result of a series of consistent, sustained decisions over time, not isolated events. To understand this process, it is necessary to adopt a clear perspective. The goal is not to appear wealthy, but to build net worth. Net worth, defined as the difference between assets and liabilities, is the true measure of financial progress. Income alone does not determine future stability. What truly matters is how much is preserved, protected, and grown. There are recurring financial patterns. Some people live permanently in debt, financing their consumption with high-interest loans that erode their saving capacity. Others spend their entire income, maintaining a fragile balance that depends on the continuity of their salary. A third group takes a different approach. They live below their means and allocate a consistent portion of their income to accumulating assets. This last pattern is the one that, over time, leads to financial independence. Before investing, certain fundamental conditions must be met. The first is a shift in mindset. The focus must move from immediate consumption to building net worth. Every financial decision should be evaluated based on its impact on net worth. The second condition is eliminating high-interest debt. Revolving credit cards and other high-rate loans create a negative compounding effect. Paying off high-interest debt is equivalent to obtaining a guaranteed return equal to the interest rate avoided. No prudent investment offers a clearer advantage than eliminating an expensive liability. The third condition is creating an emergency fund. This fund, composed of several months of essential expenses, provides liquidity and stability in the face of unexpected events such as job loss or medical expenses. Without this protection, any investment strategy can be interrupted by the need to sell assets at unfavorable times. Once this foundation is established, the next step is to invest systematically. Consistency is more decisive than the initial capital. Investing regularly, even moderate amounts, allows one to leverage the power of compound interest. Compound interest is the process by which the returns generated by an investment are reinvested, generating new returns in turn. Over decades, this cumulative effect can transform steady contributions into significant wealth. Time is an essential ally in this process. Starting early amplifies the impact of compound growth. However, growth does not depend solely on the gross return of investments. Costs play a decisive role. High fees, management expenses, and tax frictions reduce the investor's net return. In financial markets, after costs, results tend to balance out. Therefore, minimizing expenses increases the likelihood of capturing a larger portion of the available return. Simplicity and efficiency often outperform costly complexity. In this context, diversification becomes central. Diversifying means distributing investments among different assets to reduce specific risk. Rather than relying on the performance of a single company or sector, one participates in the broader growth of the economy. A broadly diversified portfolio may include equities and fixed income. Equities represent ownership in companies and offer long-term growth potential, although with higher volatility. Fixed income, such as bonds, provides relative stability and can cushion fluctuations during adverse periods. Some instruments, like inflation-protected bonds, add an additional layer of protection against loss of purchasing power. Asset allocation, that is, the proportion between equities and fixed income, should be adapted to personal circumstances. Factors such as age, job stability, risk tolerance, and time horizon influence this decision. A young person with a multi-decade horizon can tolerate greater volatility, while someone nearing retirement may prioritize stability. There is no universal combination suitable for everyone. The strategy must align with individual circumstances. Periodic rebalancing is another key tool. Over time, market movements alter the original asset proportions. Rebalancing involves adjusting the portfolio to restore the desired allocation. This process helps maintain the intended level of risk and encourages automatic discipline, partially selling what has grown more and buying what has lagged, without attempting to predict future movements. Trying to anticipate market behavior, known as market timing, introduces additional uncertainty. Financial markets constantly reflect new information and are influenced by countless factors. Predicting the optimal entry and exit points consistently is extremely difficult. Moreover, missing some of the market's best days can significantly reduce long-term performance. Therefore, maintaining a constant strategy and resisting the temptation to react to daily noise is usually more effective than frequent adjustments based on emotions. Emotions represent one of the greatest challenges for investors. Fear during downturns and euphoria during upswings can lead to impulsive decisions. However, volatility is inherent to markets, especially equities. Understanding this reality allows temporary fluctuations to be contextualized within a long-term perspective. Investment success depends more on disciplined behavior than on predictive ability. Beyond the accumulation phase, it is necessary to plan for retirement. Financial independence implies that accumulated wealth can sustain expenses without relying solely on active work. For this, future needs must be estimated, inflation considered, and a prudent withdrawal rate established to preserve capital over decades. Structured planning reduces uncertainty and facilitates orderly transitions. Investment vehicles with tax advantages can play a relevant role in this strategy, allowing deferred or reduced tax burdens. Utilizing these instruments increases long-term growth efficiency. However, their use must be integrated within a coherent overall plan. Financial education plays a fundamental role as well. Understanding basic concepts such as net worth, compound interest, diversification, and risk enables informed decisions. Without knowledge, investors may be exposed to inappropriate products or unnecessarily complex strategies. Clarity of concepts fosters confidence and consistency. It is equally important to recognize that financial independence does not depend solely on income level. People with high salaries may not accumulate wealth if their lifestyle consumes all their resources. Conversely, moderate income accompanied by discipline and systematic saving can generate long-term stability. The savings rate is often more decisive than the absolute income figure. Adequate liquidity and personal risk management reinforce this structure. Appropriate insurance and basic estate planning help protect what has been built. Each component serves a function within an integrated system aimed at financial sustainability. In summary, building financial independence is a gradual process based on clear principles. Live below your means, eliminate high-interest debt, create an emergency fund, invest regularly, minimize costs, diversify broadly, maintain appropriate asset allocation, and act with discipline in the face of volatility. Time and consistency enhance these principles through compound interest. It is not about finding extraordinary opportunities, but about consistently applying a simple, structured strategy. Over years, small, repeated decisions accumulate significant impact. Each regular contribution, every cost avoided, and every disciplined adjustment strengthens net worth. Clarity of objectives and consistency in execution allow present income to be transformed into future security. In this way, financial independence ceases to be an abstract aspiration and becomes the predictable result of a method applied with consistency, patience, and understanding.